$1 million traditional IRA in the widow's tax trap. This is going to be an absolute disaster. Hi, this is financial planner Sean Mullaney. Let's discuss. And this video is a continuation of the video from 2 weeks ago on the channel. And now, the question then is begged, though, is, wait a minute, well, what about the dreaded widow's tax trap? Isn't that going to be the disaster on the $1 million traditional IRA? So let's set the table, and we're going to use 2026 tax numbers. That's the latest up-to-date numbers we've got. So I'm going to posit Sophia is an 81-year-old widow in the year 2026. All right, her husband Sal died in 2025, so she's filing a single tax return. So that's going to increase her taxes this year, and let's see how bad it is. All right, so her year-end traditional IRA balance coming into 2026 is $1 million. She's got an online savings account of about $70,000, paid off home. If we look at her income, her gross income is almost $100,000. She is doing better than the median American her age. So this is definitely, look, is she a baller? Is she super affluent? Of course not. But she's got a paid off home, over $1 million in financial wealth, and Social Security that is well above the median annual Social Security. So she's doing just fine, but she is in the widow's tax trap. So I want to take a look at what her tax return looks like. And we start with Social Security, and essentially what happens is 85% of Sophia's Social Security is subject to tax. It was $43,000. Multiply it by 85%, and you get $36,550. Her interest income is about $2,800. Her RMD, she's 81 years old. She's got to use that factor off the IRS table, is $51,546. So her adjusted gross income is $90,896, so almost $91,000. So her gross income is between $7,000 and $8,000. It's almost quick and dirty math here, between $7,000 and $8,000 a month. Not terrible, and especially when you have a paid off home and you're grossing $7,000, $8,000 a month, you're doing just fine. Now let's think about the deductions Sophia gets. She gets a standard deduction of $16,100. She gets an additional standard deduction of $2,050 in 2026. I'm giving her the non-itemizer's charitable deduction. I'm going to assume she doesn't do any qualified charitable distributions, which are the sort of the favored way of doing charitable giving once we're living off our traditional IRAs in our 70s and 80s. But Sophia's not up for tax planning like that, so she just puts some cash in the collection plate every Sunday, and great, $1,000 non-itemizer's charitable deduction. Her senior deduction, look at this, senior deduction new for 2025, part of the One Big Beautiful Bill. It starts at $6,000. Sophia doesn't get all $6,000. She gets $5,000 and a little change. I've got a little spreadsheet here that'll sort of illustrate that. If you look here, right, so her modified adjusted gross income is between $75,000 and $175,000. So she's subject to a bit of a phase out. Basically, she loses $1 out of $6, give or take, for this deduction. So she's still getting a $5,000 and change deduction. It's still a good outcome, but it's not the full amount. So her taxable income is $66,700. Look at her federal income tax for a second. It is $93,886, right? So she's in the widow's tax trap. But I want to sort of deconstruct what this all looks like. I think there's some different things going on here. Remember, in theory, an affluent widow like Sophia could pay net investment income tax. Guess what? She does not in this scenario. An affluent, financially successful widow like Sophia could be paying IRMA in 2 years because of this income. She doesn't, right? So no IRMA, no net investment income tax when we've got $1 million traditional IRA kicking off an RMD in the widow's tax trap at age 81. I think that's very revelatory. It sort of tells us where certainly the majority of Americans should be thinking about traditional retirement accounts and maybe Roth conversions or not Roth convert. We'll come back to that. So her total tax is about $9,400. on that 91,000 of income. And if we look at this effective rate on income, for all the fear that's out there about taxes and retirement, how many Americans could tell you that a widow in the widow's tax trap with an RMD at age 81 and $1 million of a traditional IRA would be sub 10% in an effective tax rate? And remember, when Sophia and her husband were working, they were paying 7.65% on most of their income, most likely, just in FICA taxes. All right, forget income taxes for a second. So in retirement, there's obviously no FICA taxes because it's a payroll tax. She doesn't work. And, oh, by the way, the effective rate on income is actually under 10%. I bet that's news to most Americans. So that's very interesting. And I want to break this down a little further. One, I want to make an assumption against traditional retirement accounts. If we just assign all of this federal income tax against the RMD, the tax rate on the RMD is about 18.2%, which, most Americans, when they contribute to 401ks at work, are probably deducting at 22%, 24%. That's not universally true. Maybe 32%. And yes, some at 12%, but a lot are going to be doing 22, 24, 32%. So, you deduct at 24% on the way in, you take out at 18%. That's a pretty good, that's not a problem. That's a win. It's not a huge win, but it's certainly a win. Okay. And then let's think about her marginal rate is 22% on the last dollar. Think about that RMD for a second. For all the fear about RMDs, most of this RMD is taxed at the 12% bracket. That's not so bad. And then about a third of it goes off against the 22% bracket, which again, for most Americans, wouldn't be that bad of an outcome. And then think about her after-tax cash flow. So this is in the widow's tax trap, subject to the RMD. Look at this after-tax cash flow, $88,000 a year. That's more than $7,000 a month of after federal income tax cash flow. When you've got a paid-off house and you're 81 and you're a widow, that's a pretty good outcome for someone worth a little more than $1 million in terms of the financial wealth. Who knows exactly how much the house is worth? And then look at the percent of the financial wealth is less than 1%. Percent of even the traditional IRA that goes to the IRS, if we just assume all those taxes are attributable to the IRA, still less than 1%. I'll go through the senior deduction, or the tax table here. 7 levels of federal income tax, because American federal income tax loves to have rules. You see just how much, she's got some excluded income, Social Security income here. Obviously, that's going to attract 0%. Most of the Social Security goes against, between it's either excluded or the deduction covers it, which is very helpful. Now, some of that Social Security is taxed. $12,400 in the 10% bracket, almost $3,000 in the 12% bracket, and then that leaves our RMDs. And again, like I was saying, the RMD tax is just not that bad here. As you can see, a lot of it is in the 12% bracket. And again, that's a required distribution. You have to pay 12% on. Not exactly the worst outcome in the world. And sure, some of it goes against the 22% bracket. But all in all, it is revelatory that a affluent widow with $1 million in a traditional IRA, subject to both the widow's tax trap and an RMD at age 81, is still paying an overall effective rate south of 10%. That's pretty incredible. So, I think it's up for the audience to mull over this. You be the judge and jury as to just how bad taxes are in retirement. Come back in 2 weeks, because we're going to continue this investigation. We're going to look at a married couple with a $2 million traditional IRA subject to RMDs. Let's just see how bad the taxes are on that. Come back to the channel, hit subscribe, hit like below. Let me know your thoughts in the comments. Thanks so much for watching this video. If you enjoyed it, please mash that like button and subscribe to my channel. I will see you next time.